The misattribution to inflation fears is unfortunate. Your view on the bond market? Why, Dan?
Well, it ignores the fact that when you're starting to scream about how the U.S. is going to default on all its debt, there might be a subtle dislike of holding debt that people count on for liquidity. Normally we ignore the fiction. Markets ignore the fiction of the distinction between the debt issued by the Treasury and the dollars issued by the Fed. As a practical matter, they treat them the same, especially near the effective lower bound. But when somebody starts screaming about how the U.S. is going to be at risk of defaulting on its debt, some people in the market take notice. Not many people like me don't, but at the end of the day, there are enough out there to really move the market. When the market starts to feed back into that, or at least commentators start to feed back into that and start talking about that being a sign of inflation, the fact that the market's selling off in the face of this kind of a crazy political crisis, I think you're getting the wrong message, and that delivers a very, very distorted situation, especially when it bleeds into commodity markets.
Dan, I want to go to your seminal work on the age of oversupply and thinking at 60,000 feet. The money question right now is, can American chief executive officers, their boards, their CFOs, can they adapt to the persistent oversupplies we see? What's the scorecard right now?
I think it's going to be very difficult. I mean, not only have we, ramped up imports to a level that is really huge relative to pre-pandemic, and we're all familiar with the enormous backlogs that have created, price dislocations across the board when it comes to tradables. The fact is that we have now juiced up capacity in areas like China. Because suddenly, they were already running fairly low. I mean, the Chinese capacity was probably at about 78%, 76% pre-pandemic. And now it's juiced up a little bit higher, but you see additions to that capacity coming in. There's a connection between this. Here's an interesting point. There's a connection between this and the whole Evergrande story. Think about the fact that China's going to now have to reduce its dependency on investment, on real estate investment, as a result of its crackdown on Evergrande and other property developers. Well, where is that additional employment going to come from? To the extent that there is exogenous demand in the form of exports, they're going to fill it. So when it comes to U.S. CEOs, especially domestic manufacturers and other service providers here, it's going to be very, very complicated to gauge the degree of competition that's going to be coming from abroad. Right now, we may have seen the bottleneck shift from sourcing to logistics, meaning we now have a problem with all the stuff stacked up on ships and in warehouses and getting it distributed around the country. But that's going to clear. And at that point, we're going to have a very, very large manufacturing capacity from abroad, and we're going to be back to a bad situation that we had pre-pandemic.
This really goes to the heart of some of the confusion around inflation, the disagreements, the hard to understand where you should look. And just adding to this noise was a paper by one Jeremy Rudd, a Fed researcher, that was highly controversial over the past week. Can you talk about why you say this is so highly informative, given the fact that he bemoaned a criminally oppressive social order in the economics field?
Yeah, the famous footnote 2 in the paper. He came out and he was very, very critical of the Fed's own, and he is one of the senior inflation forecasters for the Fed. The Fed's own methodology, very heavily dependent on inflation expectations. His view and the research that he exercised really shows that inflation expectations are very poor determiners of actual inflation in the future. And that generally they're quite incorrect. What he was criticizing with that footnote is the fact that all of the spending and fiscal spending that is currently being teed up and has been talked about before, but really hasn't been effectuated, has been held back on this fear of 1970s style inflation coming again. And really for 40 years, we have harbored that fear. And what he's saying is that, in the long term, this has proven to be a constraint on equitable growth that could have been eliminated had we not run policy in accordance with this fear of inflation reflected in expectations. I have a paper coming out, by the way. It'll either be out at the end of next week or beginning of the following week.
Very cool.
And it's 50 pages on this issue. So I hope you all will enjoy reading it.
Well, Dan, come on soon. And if we don't get through the 50 pages, maybe bring a summary and you can share it with our audience.